Hello, we're going to do current liabilities on this video. Those are liabilities that are due within 1 year. It's going to be a short video, I hope. Most common one, of course, is the accounts payable, and that's the obligations that you have with vendors for merchandise that you purchased on an open account. A trade note is one that you sign. It's a written promise that you sign to pay interest and pay the amount at a later date. And a credit line is a short-term bank loan. That's a lot of times a line of credit that you can borrow from and pay back. And those are only reported on the balance sheet if they're actually being used. Okay. So we're going to start with an interest-bearing note. That's for $10,000, 6% interest in the terms for 8 months. So it's less than 12 months, so it's a short-term note. So we start off with, you would have a debit to cash here for $10,000 and a credit to notes payable for $10,000. Then when you pay it, of course you'll have adjusted entry in December 31st, but when we pay it, we'll debit notes payable for $10,000. Interest expense will be for the $10,000 times the 6% times 8/12 of the year, or $10,000 or $400. So the cash that you pay will be for $10,400. Okay, that would be your journal entry. Now, if it's a non-interest bearing note, which means they don't charge interest for it, but the interest is actually deducted prior to you getting the loan, so it's calculated. It's just like this will be a 6% discount rate then instead of a 6% interest rate. So in that case, the cash you'd receive would be $9,600. $400 is the interest expense, and $10,000 would be for the note. So when you pay the note back, you pay back the $10,000. It's considered a non-interest bearing note because it'll say 0% interest, but the discount rate is 6%. So when you pay it back, you don't record the interest because it's already been recorded, and that's for $10,000. Now this would be a journal entry here at the end of the year. Well, there is no end of the year, but if your year ended, it could be a discount on notes payable type of entry. Okay, and then to get your effective rate, you would equal the 400 divided by the 9,600 times 12 divided by 8. So the effective rate is 6.25% on this. Okay. So that's for the notes. Then we're going to do a little bit of payroll, a real quick introduction to payroll. Payroll is paid both by the employee and the employer for taxes. The FICA, which is FICA, the OSDI, which is also known as Social Security, is 6.2%. And you'll have to look to see what they're using, because 118,500 used to be, but it's changed a lot since then. But the 6.2% on the after you make 118,500 or wherever the dollar amount is, you no longer pay it. FICA High, which is hospital insurance, which is also known as Medicare, that's 1.45%. Of course, your FIT you use your tax tables for. SIT is 3.4% for Indiana, roughly. And then you have the county taxes, which is 1% and 0.25%. I have a range in there because it can vary, depends on the county that you're in. And then the employer has to pay also the 2 FICA taxes, and they also pay federal unemployment tax and state unemployment tax. And state unemployment tax for Indiana is on the first $9,500, and it varies between those two amounts. So let's assume that we have wages expense and the taxes are all there. Nobody's over the limit of $2,500. So for your journal entry would be wages expense for $2,500. Your FICA taxes would be the $2,500 times the 6.2%. I subtracted, sorry. Times, there we go, 155. I want to multiply. The high insurance is the $2,500 times 0.0145, which is the 3625. If you just the employees fit, I just gave it to you as 2,500, and that's at 20%. Okay, we're not going to look it up. This one is a sit is equal to the 2,500 times the 0.034, which is 85. This is equal to the 2,500 times the 0.01%, which is $25. This one is equal to the 2,500. We'll assume the max for 0.025, which is 625. It's 1/4. It's 0.25%, not 2.5%. And then the cash should be the difference. So you can do it equal. Take this amount minus the sum of all the taxes. So you get $1692.50. Okay. Then the payroll tax expense, I leave that blank to start with because you have to. This is the employer's part of the tax. Well, that's going to be $155, $36.25, and then this is equal to the 2,500 times 0.008, which is $20, and this is equal to the 2,500 times 0.027, which is $67.50. I picked that number would have to be given to you, the 2.7%, because that's someplace in between. And then this one is simply equal the sum of all the taxes, which is $278.75. That's the employer's share. Okay. Then what we'll have is we have some bonuses, if you want to give a bonus. And I did it 3 different ways. This is the simplest one. It's 10% of income before taxes, before the bonus and the taxes are calculated out. And if we assume $100,000 in income, so equal the 100,000 times the 10%, or you get $10,000. That one's not used very often. Okay. Now here I did method 2, which is the bonus is deducted, but the taxes are not. So your equation would be the bonus is equal to 10% times 100,000 minus the bonus. Okay, so then you multiply everything by 10%. So you have the bonus is equal to 10,000 minus 0.1b, or 1.1b is equal to 10,000. Divide both sides by 1.1. So you'd have equal. That wasn't equal. Equal the 10,000 divided by 1.1. So you'd receive $9,090.91. Now this is before the bonus is calculated, or the taxes, I mean, you're taking out. Okay. Method 3 is the most common one. This is the bonus is given to you after the bonus and taxes are both deducted. So what you have is 10% of 100,000 minus the tax minus the bonus. And the tax then was 30% tax rate was up here given. So you have 0.3, which is 30%, times 100,000 minus the bonus, because the bonus is deducted. So then you substitute, you know what T is, you put T at the 0.3 times 100,000 minus B in for T, then you come down all the way down through here by your math, and you'd equal to the 7,000 divided by 1.07, and so your bonus is 6542.06, and that would be the amount that you have the bonus for, but then you deduct your taxes for it. And this is considered a 10% bonus. It's a 10% bonus after taxes and bonus is deducted. It's 10% of net income is how they'd word it. Okay, so this is your short lesson on current liabilities. There's 2 more videos. One's on warranties and expenses. Warranties and premiums is the other videos that you may want to watch. Okay, so thank you, and I'll see you later.